Assalamu alaikum. This is lecture number 18 of Advanced Cost and Management Accounting. The topic that we are discussing is budgeting. Budgeting is essentially a tool for planning and control. We have said that the budget is organized on a company-wide, organization-wise basis at least once in a year. It sets out what the organization intends to do in the forthcoming period, whatever the budget period, duration of the budget period is. The detail is required in this process to be able to match the plan with actual performance. So the planning part is the budgeting part when different departments get together, and we covered in our previous sessions the process of budgeting. The different departments will get together and they are going to formulate what their plans for the forthcoming period will be. That is the planning stage, and that plan acts as a tool for controlling the actual performance. Then when actual is compared with the plan, divergences can be identified and any action required can be planned and taken. We are going to look at the various aspects of this budgeting, as budgeting is quite an important aspect of an organization's overall performance and activities. It represents a very important part and a significant part, because if the planning for the next period is done accurately and correctly, then when the organization tries to match the activities with the plan, it seems to be on the path that is desired. Budgeting in some organizations can take a very long time. It should be paced and it should be occurring at a time so that the budget details and the final budget is available before the start of the budget period, and the organization knows how to proceed for the next period. Today we are going to look at various aspects of budgeting. There are many functions which the budgeting incorporates. As we said, it is a tool for planning and control. We can see how the different functions can be performed by following the budget process. The multiple functions of budgets. Planning annual operations, managers must produce detailed plans for the implementation of long-range plans. Encourages managers to anticipate problems before they arise. So one aspect is that all managers of the organization come together, they plan their own work in each area, and of course each area must be coordinated. All of them must therefore coordinate with each other and have an overall general plan for the organization. So first of all, it encourages managers to get together and together form the objectives and goals for the organization. And secondly, it also encourages managers to anticipate the problems and to look ahead and to try to foresee what will be the activities and what might be the hurdles, and therefore what might be the ways in which to overcome those hurdles during the forthcoming year. Coordinating the activities of various parts of the organization, the budget serves as the vehicle through which the actions of the different parts of the organizations can be brought together and reconciled into a common plan. Coordination, therefore, becomes a necessary part of the budget. All the different parts of the organization. When I say different parts, we are looking at perhaps the sales function, the production function, the buying function, the storage, the warehouse function, the administration and financial side. So all these functions, they must come together and have a plan that is common to all for the organization. For example, if sales has a plan of a certain amount of products to be sold during the next year, well then the production must produce the required quantities for the sales to be able to sell. So unless the production has a plan which meets the demand of the sales will not be able to fulfill or accomplish their own plan. So this has to be coordinated. Similarly, for the production to carry out production, it needs the various raw materials and other resources like machines and so forth. So the buying and the purchasing sections and other sections, they need to have a plan to acquire in time all the goods required, resources required, goods and labor required to make them available to production, so that production takes place as scheduled and those goods can be made available to the sales for the selling. So all these various functions need to coordinate, and they need to arrive, as we are saying, with a single goal which the organization must work towards in order to achieve its objectives. Communicating plans to the various responsibility center managers, everyone in the organization should have a clear understanding of the part they are expected to play in achieving the annual budget. It's not enough that you have a plan and you are prepared to go ahead during the year with a certain amount of planning and budgets. That plan then has to be communicated to all the participants and all the employees of the organization. So they must have a clear idea of what their role is, what they are expected to do in order to meet the plan. So communication is another function which we can say is occurring because of the budget. We have the budget, it has to be communicated, so all the departments need to get together. First, the senior management get together and agrees on the budget, and then it has to be communicated down the line to all the employees. So communication is therefore another function of the budgeting process. Motivating managers to strive to achieve the organizational goals. Budget is a useful device to influence managerial behavior. A budget is a standard that managers may be motivated to achieve, like a challenge. Motivation is a very key aspect of management. The drive and motivation within the organization will probably form the basis of the results the organization will achieve. And so this budgeting process, this provides an incentive, a motivation. We've said like it is a challenge for the management to achieve. Motivation, organizations go through various different type of exercises, various different types of trainings, and various different types of mission and vision and those kind of build-up programs, leadership programs. All these are designed to provide motivation within the organization, the motivation to excel, the motivation to achieve, to expand, motivation to grow. All these aspects for the organization which are essential, and motivation will play a key role within the organization and its ability to achieve objectives. So budget is playing a role of providing a motivation. It is setting a target for all the different departments, and it is an aim which all the departments must achieve together. This is the other important aspect of this budgeting process, that it is motivation as well as teamwork. All the departments must achieve their targets and their budgeted requirements in order for the organization to accomplish its goal. We have said that production needs to produce whatever is required for selling. So if the production falters on its plans and for reasons of motivation or else is unable to meet its targets of production, then naturally sales will also not accomplish their targets because they don't have the products to sell. So they need to have this teamwork and coordination and therefore support within the organization, which is going to result in better performance for the entire organization. All of them have their targets. All targets must be met. Each are interdependent. If the buying is going to provide the required materials, production will be able to produce and the selling will be able to sell. That's the kind of coordination and motivation and teamwork which is arising, and budget is acting as a tool to provide this motivational aspect within the organization. Controlling activities. A budget assists managers in managing and controlling the activities for which they are responsible. By comparing with actual results, managers can ascertain which costs do not conform to plan and require attention. This process enables management by exception. In addition to planning, control is another aspect within the organization which is accomplished through the budget. As we have a detailed and analyzed plan for all departments for the next budget period, comparison with actual is going to provide the differential where budgets are not being met, costs are being exceeded, production is not being met, targets are not being met. So this comparison of budget and actual is going to provide a control mechanism to act to correct the matters, for management to take action to correct any activity that is lacking behind. Management by exception, we have just said. Management by exception is a way of management, of way of controlling activity by looking at items and activities and events that are not conforming to the plan. So we look at if things are going according to plan, those are not given that much attention. Attention is devoted to areas where there are differences between the actual and the plan. So an exception report, you can say, can be drawn up. The exception report is going to highlight whatever activities and areas are not in accordance with the plan. Whichever area needs management attention and it needs some corrective action. So the exception report provides management with these details of departures from plan and where action and attention can be devoted. This makes management an easier task and accomplishing the plan an easier task, that by the comparison, providing the control and taking actions at the time as soon as they arrive or as nearly as soon as they occur, then management is able to perform in a better way. They are able to correct the problems and direct the organization in its desired direction. Evaluating the performance of managers. Success is measured in meeting the budget. Bonuses may be awarded on achieving of targets. Performance of managers is a key aspect of conducting the entire management. Evaluating their performance and rewarding them accordingly. Because budgets are setting the targets, it is therefore possible to measure the performance of the managers, whether they have achieved targets or whether they have not achieved targets. And in this way, even rewards and bonuses can be designed and they can be instituted in a manner that those employees and management personnel are rewarded when they are achieving their plans and they are excelling. So therefore, this aspect of budgeting is also another dimension, that it provides the organization and it enables it to evaluate management performance and to reward it accordingly. As a single budget is used to serve several purposes, there is a danger there may be conflict with each other. Conflicting roles of the budget. After seeing the different functions that the budget performs for the organization with regard to planning and control, let us now look at some of the conflicting roles that can arise because of the budget. We have said it is serving many functions. So as it is serving many functions, one needs to be careful, management needs to be careful of conflict that might arise in the different purposes that budget is being used for. Sensitivity is required, management focus is required. When you are setting the budget and you are using it for planning and for control, then look for the conflicts and try to avoid where conflicting roles appear, and therefore the decision making is improved to an even better level. Demanding budgets that may not be achieved may be appropriate to motivate maximum performance, but they are unsuitable for planning purpose. So one aspect of this conflicting role can be seen in where you set the target in your budgeting and in your planning. If you want to motivate your staff and employees to get the maximum performance, then you set the budget at a high level, which perhaps won't be achieved. You might even know, management might even know, that this level of budget will probably not be achieved because it's quite high. But because it motivates the employees to try to reach the targets and the budget, therefore they might consider that as a suitable target setting and a suitable budget for motivational purposes and extract the best. But if it is not going to be achieved, then it is probably not a very good plan to be used for planning, because when you are planning, then you are going to make resources available accordingly, you are going to time, you are going to have the assets, all the infrastructure required for production, your purchasing, ordering, all that thing, plus your sales force and the way that you are spread out in territories by the sales, all those aspects are going to be coordinated and aligned to meet the objective, which is set by the budget. If the budget is too high and it won't be achieved, then perhaps all the other activity of planning that is going to try to achieve that, it might be unnecessary, there might be waste in it, and there might be wasted resources causing costs and losses to the organization. So such a budget, there is now therefore a slight conflict at the level, the budget, that level is being set within the budget, but the level is set first for a motivational purpose and secondly for a planning purpose. So it needs to be carefully handled and carefully managed so that it does not spoil the planning part and still provides the motivation. There is also a conflict between planning and performance evaluation roles. Budgets are set in advance on anticipated circumstances. Performance should be based on an adjusted budget to reflect actual operating circumstances. Another area possibly of conflict is this budget being used for performance evaluation. Managers are being used and are being assessed for their performance based on the budgets. The budgets are, as we said, at the start of the budget period, based on anticipated events and activities. And therefore, it is a desired performance of the organization for the budget period. As time moves along and activities are occurring, there are many factors and there are many aspects within a business environment that change, which are beyond the control of the organization and the entity. In our country, we can take the example of availability of gas, sometimes there is gas load shedding, availability of electricity power, sometimes there is shortage of electricity power. So these are all aspects which are probably beyond the control of management to an extent. And so when these factors are taken into account, and if they are going to reflect on the performance, then these are what can be regarded as uncontrollable factors. And so management performance is being evaluated on targets and budgets set at the start of the period with only what is expected to occur within the period. And as time goes by, events take place and other factors occur which are beyond the control of managers. So therefore, their performance should be adjusted for those factors so that they are not penalized for things which they are not in control of. Because penalizing them for aspects and factors which are beyond their control might cause demotivation, and they will feel hard done by the organization if their performance is measured on things which were not within their control. So this is the conflict of the budget which must be borne in mind, and care should be taken to adjust for these kind of things when using the budget for performance evaluation. The budget period. The conventional approach is that once a year, the manager of each budget center prepares a detailed budget for 1 year. The preparation of budgets on an annual basis has been strongly criticized on the grounds that it ties the company to a 12-month commitment. This can be risky as the budget is based on uncertain forecast. So now we will examine the period for which the budget is prepared. And we have said that this occurs at least once in a year. The normal and traditional way is before the start of the year is to finalize a budget for the rest of the year. This annual budget process has been criticized. This 1 year is considered as too long a period to forecast. Too many events occur in a fast-changing world, and there are so many changes that to predict the entire activities of 1 full year, it is regarded that this is a difficult and inaccurate thing. Many inaccuracies can be built in, and as in the end, it may be found that the budget was quite inappropriate. So therefore, the period of budget is going to be quite essential, and we will examine what would be a more suitable period for the budgets, and we will examine how organizations are overcoming this problem, where the period of the budget is not extended for a full year so as to provide too much uncertainty in the budget. Forecast can be given for a shorter period of time. An alternative approach is for the budget to be broken down by months for the first 3 months and by quarters for the remaining 9 months. The quarterly budgets are developed into monthly budgets as the year proceeds. In the second quarter, monthly budgets for the third quarter is prepared, and so on. One approach that is being taken is that the whole year is divided into 4 quarters, and for the first quarter, the budget is prepared on a monthly basis. So if we start the year, January, February, and March, each month will have a detailed budget for each month. And then there will be some approximate figures for the next quarter and all the other quarters, the other 3 quarters, and so you have the full year's budget. First 3 months are on a monthly basis, detailed for each month, and the other quarters are on a quarterly basis. The quarterly basis itself suggests that those are going to be some approximations and estimates. Now, as time moves on and the first quarter is completed, then in the next quarter, that quarter is broken down into months. For the second quarter, we'll have April, May, and June. We will have monthly budgets in the second quarter, and the third and the fourth quarters will remain as quarterly budgets. So this is one way of, as we move along. So now the budget for the second quarter essentially will be made at the end of the first quarter. So at any time, you are actually doing a detailed forecast for 3 months and not doing it for the entire year. A new budget for a 5th quarter will also be prepared. This process is known as continuous or rolling budget. So in addition to making the budgets on a monthly basis and having the remaining quarters as quarterly budgets, one quarter is added every time one quarter finishes. In other words, you have a 3 monthly budgets, January, February, March. You have 3 quarterly budgets, and you also add on a 4th quarter. So you have 4 quarters in quarterly budgets and the 3 monthly budgets of the 1st quarter. This will ensure that as you go along within the quarter and you are carrying on the activities, you always have 1 year's forecast on quarterly basis in front of you. So as one quarter ends, the next 3 months, in our case, April, May, and June, they are taken on a monthly basis, and 1 quarter is added at the end so that you always have 4 quarters having a continuous budget on a continuous basis. You have a budget and a forecast for 4 quarters. This is referred to as the rolling budget or the continuous budget. In this way, you are continuing to have a budget for 1 year. As 1 quarter is completed, 1 quarter is added at the end of the period. Rolling budgets and continuous budgets, they provide a kind of continuity so that you don't go through 1 year and then start again. It provides a continuity, and you have a continuous process of budgeting and thinking and planning. So this way, it turns out that planning is a continuous process. It is not something that you can do at the start of the year, and then for the rest of the year, you just look at your results, look at the activities, and compare the two and see how you perform. Because at the start of the year, forecasting for the entire full year is too long a period to forecast accurately. So every quarter, there is a monthly budget to be prepared, and therefore you are doing it on a quarterly basis, rolling your plans forward and having at all times a more recent forecast and a more recent budget to work with. This ensures that a 12-month budget is always available by adding a quarter as the quarter just ended is dropped. Rolling budgets ensure that planning is not something that takes place once a year. Planning is a continuous process, and managers are encouraged to constantly look ahead and review future plans. Hence, it appears that planning in the organization is something that must constantly be happening. It must constantly be occurring at short intervals to be able to look ahead, look into the future, and try to anticipate the problems the companies and organizations might face and how management intends to overcome and deal with those problems. There are many times that organizations will even make larger decisions, and larger means value terms. The decisions will be large and they will have significant impact on the organization's resources, such as acquiring new assets and new machinery and new facility. Now, all these decisions will need to take into account the activities that are happening at the current period of time. And therefore, the forecast becomes a very important thing, that company is going to commit its resources, commit all its funds and other resources, and they are going to do them with an expectation of having a future production, a future asset availability, which is they are going to expect cash flows from and profitability from. Those things are based on forecasts and are based on planning, and therefore the accurate the planning is going to be, the forecast is going to be, the more likely it is that forecast will be met and the assets will provide the return desired. Now we will look at a detailed illustration and an example where a budget is going to be compiled for an organization and all the different details that go along within the organization that must be incorporated in the plan. This is a fairly detailed exercise and a fairly detailed plan as far as our exercise and our course goes. Of course, in real terms, organizations will go into far greater detail to prepare plans for their budget periods. We are going to look at the enterprise company. The enterprise company manufactures two products known as alpha and beta. Alpha is produced in Department 1 and beta in Department 2. The following information is available for year 2000X0. Standard material and labor costs. Material X 7.2 per unit. Material Y 16 rupees per unit. And direct labor 12 rupees per unit. Overhead is recovered on a direct labor hour basis. The information that we are given will need to be incorporated within our plan and needs to be carefully considered. So we have an organization where we are told the costs of material and labor. The organization produces two products, the alpha and the beta. Both are going to require labor and material and other resources. Overheads will be incurred. Two materials are being used. We are told material X costs rupees 7.2 per unit and material Y costs rupees 16 per unit. We also know that direct labor costs rupees 12 per unit. We have gone through the entire exercise where overheads are assembled and they are allocated onto products by use of an overhead rate. And the basis we will use here is the direct labor hours. Standard material and labor usage for each product is as follows. Model alpha and model beta. Material X 10 units for model alpha and 8 units for model beta. This means that in order to produce 1 unit of alpha, you need 10 units of X, and for 1 unit of beta, you need 8 units of X. Similarly, for material Y, 1 unit of alpha requires 5 units of Y, and 1 unit of beta requires 9 units of Y. We have seen in the last slide the price of each of these units of material. And each of these models, model alpha, they required labor hours. Labor hours required for alpha are 10 hours, and model beta requires 15 hours. So now the next information we are given is the amount of resources, material, and labor required for each unit. Two products, alpha and beta, both require material. Alpha requires material X 10 units and material Y 5 units, and beta requires 8 units of X and 9 units of Y. We are also given what the labor hours for each unit are required, and that will give you the direct cost for the units. The balance sheet for the previous year end 2000X0 was as follows. Fixed assets, land 170,000, buildings 1,292,000, less depreciation 255,000, giving net book value of 1,037,000. Current assets comprise stocks of finished goods 99,076 and raw materials 189,200. Debtors amount to 289,000 and cash amounts to 34,000. This gives the total current assets of 611,276. Current liabilities, which are basically creditors, they amount to 248,800, and when these are deducted from the current assets, you get net current assets of 362,476. The net current assets added to the fixed assets amount to 1,569,476. Those are the net assets, 1,569,476. These are represented by ordinary shares 120,000 ordinary shares, usually ordinary shares are priced at rupees 10 each. That amounts to 1.2 million, and reserves of 369,476. And this gives the total of equity within the organization of 1,569,476. That completes the balance sheet. So in addition to the direct costs and the labor, material, the units required for production of each unit, and the units that are going to be consumed in each unit of product, the labor required, that was the detail of per unit on a per unit basis. And in addition to that, we are given the balance sheet at the previous year end. So that's the opening position in a way. The assets that are there at the start of the period, the land, the building, depreciation, and then the current assets. Current assets included stocks and debtors and cash, stocks of raw material and stocks of finished goods. Why should this balance sheet be important? Well, for the plan of the future period, the next budget period, in order to arrive at the amount to be produced, the stock in hand will need to be taken into account. All these balances of assets that are there at the balance sheet date at the start of the year, therefore form the opening balances, and your production plan is going to comprise of your inventory at the start, what might be inventory at the end, and what is the total requirement for production. So that will give what should be produced during the year. That will be the production plan. Similarly, cash resources. A cash budget will be prepared. The cash budget will show all the inflows, receipts from sales, and all the outflows, which are expenses and payments to creditors. In order to arrive at how much cash is going to be received, we must see what is the debtor position, the amounts owed at the beginning of the year, and what is likely to be the debtor's position at the end of the budget period. And then we will look at what sales are made during the period, what cash we expect to receive. That will give us the balance of cash for each period and for the entire budget period. And similarly, for the creditors, we'll see the details as we go along. So we are now given the opening balance sheet, which is going to form the opening balances, and those are going to be used in our budgets for production, for sales, for cash, as we'll see in a minute. Other relevant data is as follows for the year 20X0. Now this is the information which is forecast and information available for the year. Sales forecast in units, alpha 8500 and beta 1600. Selling price per unit, rupees 400 for alpha and 560 for beta. Ending inventory required in units 1870 and 90. Beginning inventory 170 and 85. This is the forecast of the selling price and the units in inventory. The beginning inventory is what is going to be there at the start of the year. And when we look at the balance sheet, the opening balance sheet provides inventory and stocks of finished goods. So those finished goods, the value translated into units is what we are looking at over here now in this data, where we can see that the beginning inventory is 170 units of alpha and 85 units of beta. Similarly, the closing inventory, we have said that this is the closing inventory required. So this is what the organization and the managers feel that they must have in stock at the end of the year. This is going to have an impact on the amount produced. Direct material for material X and for material Y. Beginning inventory in units is 8,500 and 8,000. Ending inventory in units is 10,200 and 1,700. Budgeted variable overhead rates per direct labor hour. We have said overheads have been allocated on the basis of direct labor hours. indirect materials, the rate is 1.2 and 0.8. Indirect labor, the rate is 1.2 and 1.2 for both the products. Power, variable portion, 0.6 and 0.4. And maintenance, variable portion, 0.2 and 0.4. All these are rates of rupees per hour. Now when looking at the overheads we are saying are going to be allocated on the basis of direct labor hours. So we are given the direct labor hour rate of overhead. And we saw that for indirect material, for example, in alpha, the rate was 1.2 per hour. That provides a basis to allocate the indirect material and the indirect labor and various overheads. For power, we saw that we were given the variable portion. Power, we have talked about semi-variable costs before. Semi-variable costs are those costs that have a fixed portion and they have a variable portion. Power can be divided, therefore, into a fixed portion and into a variable portion. The power that is consumed by the machines while they are running for production, that is regarded as the variable portion. It is going to vary as the production takes place and products are being produced. But there will also be a fixed portion. That portion will be, for example, the lighting, heating, air conditioning of the admin block and all the offices, which are going to be incurred regardless of what the production is. So that part will be the fixed part of power. And the machining part will be the variable part. So we were given under variable overheads the variable portion of power. Similarly for maintenance. Maintenance is also a semi-variable expense. It has a fixed portion and it has a variable portion. Fixed portion is usually the scheduled maintenance of the plant, and that usually whatever is the duration, either once a year or once in 18 months, when the plant is shut down for regular maintenance. That is going to happen regardless of what the production level has been. But then there will be other maintenance, and that will be as production goes on and throughout the year, wherever it is required. That will probably relate to the usage of the machine. Therefore, that part is the variable part. The variable portion of maintenance is that maintenance which is being required for the operation of the machine during the year. So two portions of maintenance, the variable portion and the fixed portion. In the variable overheads, we have seen what is the rate of the variable portion of maintenance. Budgeted fixed overhead. Depreciation, 100,000. Department 1 and 80,000 for Department 2. Supervision, 100,000 and 40,000. Power, the fixed portion, 40,000 and 2,000. Maintenance, fixed portion, 45,600 and 3,196. Now we are given details of the fixed overheads as budgeted. Depreciation is usually a fixed overhead, and it usually doesn't vary, and it relates to the machines being used in the various departments. We have two departments, 1 and 2, and we are given the depreciation for each. We are shown that depreciation for Department 1 is 100,000 and for 2 is 80,000. Power and maintenance, we just talked about their fixed portion and their variable portion. The variable portion had been included in the variable overhead, and now in the fixed overhead, the fixed portion is being included. Estimated non-manufacturing overheads, stationery, etc. for administration is 4,000. Salaries, sales, 74,000. Office, 28,000. Commissions, 60,000. Car expenses relating to sales, 22,000. Advertising, 80,000. And miscellaneous office expenses of 8,000. So total of the non-manufacturing overheads of 276,000. So we can see the budget process is going to include not only the manufacturing costs, but it will also include the non-manufacturing costs. And so that's how the cost of the entire organization will be put together and included in the budget. We have seen the non-manufacturing costs, such as the salaries to the sales staff, the stationery of the admin, advertising cost, things of that nature. There's always a miscellaneous which adds on to little expenses, short expenses put together. So the entire amount of our non-manufacturing overheads has been estimated at 276. This is now the information that is available for us for this budget. Budgeted cash flows are as follows. Quarter 1, Quarter 2, Quarter 3, Quarter 4. All are in rupees thousands. Receipts from customers, 1,000. In Quarter 1, 1,200, 1,120, and 985. Payments for materials, 400, 480, 440, 548 for each of the quarters. Payments for wages, 400, 440, 480, 646. Other costs and expenses, 120, 100, 72, and 14. These are the payments and receipts. So this represents the cash inflow and outflow. You are required to prepare a master budget for the year 2000X0 and the following budgets: sales budget, production budget, direct materials usage budget, direct materials purchase budget, direct labor budget, factory overhead budget, selling and administration budget, and the cash budget. So now we have been given the information on the various costs and other aspects of the organization to form the entire budget. We have been asked to produce several budgets. One is going to be the master budget, which will be for the whole organization, and then there will be certain portions. We will look at all the different budgets: the sales budget, the production budget, the materials usage budget, the materials purchase budget, the labor budget, cash budget, and so on. It will be important to note that budgeting is an exercise which has as its starting point the sales budget. So we are going to start by looking at our sales budget. Why should the sales budget be the starting point? This is something that needs to be noted and carefully understood, that the entire budgeting exercise is going to be based on what the organization expects to sell. That is the essential and first part of the budget. Once you know you have a target for the sales, then you can target the production along with it. You can target the purchasing. You can target the financing. All other aspects are going to be based on one initial sales budget and sales figure, and that is the essential figure to start with. And we will look at the solution in our next session. The next session will include the preparation and details of all these budgets, and we will see how all the budgets are made, starting, of course, with the sales budget. That will be the basis and focus of our budgeting process. That's all for this session. Thank you very much.